Right now, as you watch this video, millions of hardworking Americans are looking at their bank accounts feeling a quiet sense of accomplishment, completely unaware that a silent, invisible mechanism is slowly draining their financial future. They wake up early, pay their bills on time, avoid high-interest credit card debt, and diligently set aside money every single month into what they believe is the ultimate safe haven. On paper, everything looks clean, responsible, and secure, yet beneath the surface, they are committing a single, fundamental error that could cost them hundreds of thousands of dollars over their lifetime. It is not an aggressive scam, a volatile meme stock crash, or a reckless gamble on a risky venture, but rather a subtle psychological trap built directly into the plumbing of our modern banking system. If you have ever left money in a standard account thinking you were playing it safe, there's a very high probability that you are making this exact mistake right now. Before we dive into the hidden mechanics of how this happens and how you can protect yourself starting today, please take a quick second to hit the like button and subscribe to the channel so you never miss an episode. To understand why this trap is so effective, we have to look at a middle-class family sitting at their kitchen table on a Sunday evening, reviewing their monthly budget. They have $50,000 sitting neatly in a traditional checking or basic savings account, and every time the primary earner logs into their mobile app, seeing that five-figure number brings an immediate wave of relief and emotional comfort. Hostias, in their mind, that money represents safety, freedom, and protection against the unpredictable storms of life. But what this family does not realize is that while the nominal number on their screen stays perfectly still, the actual real-world energy and purchasing power of those dollars is steadily bleeding away week after week. They are experiencing what behavioral economists call the money illusion, a psychological phenomenon where human beings naturally measure their wealth in raw dollar amounts rather than what those dollars can actually buy in the real world. The origin of this psychological trap goes back decades, rooted deeply in the collective memory of generations who lived through periods of severe economic distress. For our grandparents, holding cash in a vault or a local bank was the ultimate symbol of survival, because during the Great Depression, cash was the only asset that survived when banks collapsed and credit markets completely froze. That generational instinct was passed down from parents to children, embedding a deep emotional belief that cash is king and that having money sitting quietly in a bank account is the highest form of financial prudence. However, the economic reality of the 21st century operates on an entirely different set of rules than the world of 80 years ago. Today, holding static cash in an environment of shifting interest rates and persistent price increases is not a neutral act of preservation, but an active, continuous financial loss. Consider what actually happens when you deposit $10,000 into a typical traditional brick-and-mortar bank account, paying an average interest rate of less than 0.1%. At the end of a full year, the bank generously rewards your loyalty with roughly $10 in interest, leaving you with $10,010. On the surface, you have not lost a single penny, and your account balance technically grew, satisfying the brain's desire for safety and incremental progress. But during that exact same 12-month period, the cost of goods, services, healthcare, housing, and groceries across the country rose at a significantly higher rate, quietly shifting the real value of your deposit downward. While your digital screen displays $10,010, that money now only possesses the purchasing power equivalent to roughly $9,500 from the year prior. You did not spend the money, you did not gamble it away, and you did not make a foolish purchase, yet $500 of real-world value vanished into thin air. This brings us to the first major open loop that almost nobody in mainstream media clearly explains, which is the massive structural disconnect between nominal yield and real yield. When financial institutions advertise rates, or when people celebrate earning 4 or 5% on a short-term financial instrument, they are focusing almost entirely on nominal yield, which is simply the surface-level interest rate you see on paper. But real yield is the only metric that actually determines whether your wealth is growing or shrinking, because real yield is calculated by taking your nominal return and subtracting both the true rate of inflation and the hidden impact of taxes. When you factor in the reality that interest income is taxed at your ordinary income tax rate, a 5% surface yield can quickly dissolve into a negative real return, once local taxes, federal taxes, and real-world price increases take their bite. At first glance, this seems like a minor inconvenience that only impacts high-net-worth investors, but the truth is very different when you compound these numbers over a decade or two. Imagine two 35-year-old colleagues, Sarah and Mark, who both earn similar salaries and manage to save $20,000 a year in cash above their emergency reserves. Sarah, terrified of market volatility and driven by the desire for complete safety, keeps her annual $20,000 in a standard low-yield bank account year after year, watching her total balance grow cleanly on her screen. Mark, on the other hand, takes the time to understand the friction of inflation and tax efficiency, systematically placing his annual savings into a well-structured, low-cost, broad market asset allocation. that historical data shows reliably beats long-term price erosion. Over a 20-year career, both individuals put in the exact same amount of hard work, discipline, and sweat equity, yet the financial trajectory of their lives diverges by hundreds of thousands of dollars. By the time they reach age 55, Sarah looks at her account and sees $400,000 in accumulated cash savings, feeling proud that she never suffered a single paper market decline or lost a night of sleep during financial crises. However, when she goes to buy a home, pay for a child's college tuition, or calculate her retirement timeline, she suddenly realizes that $400,000 buys less than half of what it bought when she started her journey 20 years earlier. Mark, despite experiencing multiple dramatic stock market pullbacks, headlines of impending doom, and periods of temporary portfolio declines, sits on a net worth that has compounded well past $1 million. The tragedy of this scenario is that Sarah did not fail due to a lack of effort or bad intentions, but because she confused absolute safety of principle with safety of purchasing power. This subtle detail changes everything about how we ought to view financial risk in our personal lives. Most people define risk as the temporary drop in the visible value of an investment, which creates immediate emotional anxiety and triggers our primitive survival instincts to protect what we have. When a chart turns red or headlines warn of market volatility, the brain registers that movement as danger, prompting people to run toward the perceived shelter of cash and guaranteed fixed balances. But behavioral finance shows that by over-indexing on short-term stability, individuals unknowingly exchange temporary volatility risk for permanent purchasing power risk. Permanent purchasing power risk is far more dangerous precisely because it operates without any drama, sirens, or red charts, quietly eroding your financial standing day by day without ever triggering your internal alarm bells. To fully understand how deeply embedded this dynamic is in our daily lives, we have to look behind the curtain at what commercial banks actually do with the money you leave in your account. When you deposit cash into a financial institution, the bank does not put your physical dollars into a secure steel vault with your name on a label waiting for you to return. Instead, the bank treats your deposit as a low-cost loan that you have generously extended to them, paying you a tiny fraction of a percent in interest for the privilege. They then take your capital and immediately lend it out to home buyers, business owners, and credit card users at significantly higher interest rates, capturing the massive spread between what they pay you and what they charge borrowers. In essence, by keeping large sums of idle cash in low-yielding accounts, you are effectively subsidizing the bank's profitability while taking on all the hidden risk of currency devaluation yourself. This is where the story changes completely, because the modern landscape offers tools that allow everyday individuals to flip this script entirely if they know where to look. For decades, institutional investors and wealthy families have understood that cash should never be viewed as a long-term wealth generator, but rather as a strategic tool designed for very specific operational purposes. They categorize their capital into distinct buckets, ensuring that short-term liquidity needs are strictly separated from long-term wealth preservation and growth engines. The problem facing millions of middle-class Americans today is not that they hold cash, but that they hold far too much of it in the wrong vehicles for the wrong reasons, driven by an understandable fear of making a mistake in an increasingly complex world. Let us explore what happens psychologically when someone decides to finally fix this issue and move their idle capital into productive environments. The immediate obstacle they run into is the classic paradox of choice, where the overwhelming volume of financial advice, conflicting media headlines, and complex jargon creates a state of total analysis paralysis. One expert on television screams that a massive market crash is imminent and that cash is the only safe refuge, while another strategist claims that holding cash during a bull run is financial suicide. Facing this wall of contradictory noise, the average person defaults to doing absolutely nothing, choosing the comfortable familiarity of their existing bank account over the intimidating uncertainty of making an active investment decision. What happened next in the evolution of consumer banking surprised even experienced financial observers over the last several years. As central banks shifted interest rate policies to combat global economic shifts, a massive gap emerged between traditional commercial banks and high-yield financial options, creating an unprecedented transfer of capital. Savvy account holders quickly realized they could earn significantly higher yields on their liquid cash reserves simply by moving a few digital sliders on their smartphones, shifting billions of dollars out of legacy brick-and-mortar institutions. Yet, despite widespread news coverage and endless social media tutorials explaining these yields, a massive portion of the American public remains completely frozen, leaving hundreds of billions of dollars sitting in accounts that pay virtually zero interest. This brings us to a fascinating psychological trap, known as the status quo bias, where the human mind naturally overvalues its current state of affairs and views any change as inherently risky or burdensome. When people contemplate moving their emergency savings or extra cash to a higher yielding account or an automated index strategy, Their brain exaggerates the effort required and manufactures worst-case scenarios about potential friction or lost access. They tell themselves they will get around to researching better options next weekend, or after tax season, or when the market calms down, continuously kicking the decision down the road while their balance suffers daily erosion. In behavioral science, this delay is known as friction loss. And over a multi-year period, it represents one of the single largest uncaptured wealth transfers in modern personal finance. Consider the structural impact of how inflation quietly interacts with life milestones over a standard working career. Suppose you are saving money for a down payment on a home, setting aside capital in a traditional savings account with a 3 to 5 year timeline in mind. You save diligently, sacrificing vacations and dining out, accumulating $75,000 through sheer grit and discipline over a 48-month period. But during those same 4 years, average home prices, construction materials, and regional real estate demand elevate the cost of your target neighborhood by 15%, moving the benchmark goalpost further away despite your heroic savings discipline. Because your cash yields failed to keep pace with the specific inflation rate of real estate assets, you end up further away from home ownership with $75,000 than you were when you started with $20,000 years earlier. This exact dynamic plays out across healthcare costs, higher education, retirement, living expenses, and vehicle purchases, proving that inflation is never a uniform number across the entire economy. While official government metrics measure a broad basket of consumer goods to establish a baseline inflation statistic, the personal inflation rate experienced by an individual household often looks wildly different depending on their stage of life. A young family paying for childcare, housing, and medical insurance experiences a vastly higher personal inflation rate than a retired couple with a paid-off mortgage and Medicare coverage. Therefore, relying on standard baseline numbers to gauge whether your cash is keeping pace can lull you into a false sense of financial safety, while your specific life expenses outpace your returns. At this point in the conversation, an important question naturally arises that almost nobody talks about. If holding idle cash in traditional accounts is a guaranteed way to lose real purchasing power, does that mean everyone should immediately invest every single spare dollar into high-risk assets or the stock market? The short answer is an emphatic no, and understanding why is critical to avoiding an even bigger financial blunder. Moving to the extreme opposite end of the spectrum by keeping zero cash reserves leaves an individual completely exposed to short-term life shocks, forcing them to sell long-term investments at the worst possible time during a sudden market downturn or personal crisis. The goal is not to eliminate cash entirely, but to optimize cash reserves with surgical precision so that every dollar has a clear, intentional purpose. To construct a resilient personal strategy, world-class financial educators break down cash management into 3 distinct operational tiers that balance immediate liquidity, short-term flexibility, and long-term inflation defense. The first tier is your daily operational checking account, designed strictly to handle regular monthly income, utility payments, groceries, and predictable baseline living expenses. This account is intentionally kept lean, holding only enough buffer to cover 1 to 2 months of routine expenses to ensure that bills are paid seamlessly without risking overdraft fees or operational friction. Treating your primary checking account as a transient landing strip rather than a long-term holding pen is the first crucial mental shift required to overcome the money mistake. The second tier consists of your true emergency fund, which serves as your emotional and financial shock absorber against unexpected medical bills, sudden job losses, urgent home repairs, or major economic disruptions. Financial consensus typically recommends holding between 3 to 6 months of actual baseline living expenses in this category, keeping the capital completely safe from stock market fluctuations and accessible on short notice. However, instead of letting this essential shock absorber sit in a traditional bank account earning negligible return, top-tier wealth managers position these funds in high-yield liquidity vehicles that offer daily access while capturing market-competitive interest rates. By placing your emergency fund in a high-yield vehicle, your safety net continuously works to defend itself against inflation, without sacrificing its core function as a liquid shield. The third tier represents your strategic investment fuel, which includes any liquid capital that exceeds your 6-month emergency boundary and is not earmarked for immediate expenses over the next 2 to 3 years. This is precisely where millions of Americans make their critical mistake, allowing hundreds of thousands of dollars of Tier 3 capital to spill back into Tier 1 checking or standard low-yield accounts out of habit or fear. When excess capital sits idle in Tier 1 or basic Tier 2 structures for years on end, it ceases to act as protection and begins operating as an anchor, dragging down your overall wealth trajectory. By redirecting this surplus capital into broadly diversified, tax-efficient growth engines, you ensure that your long-term purchasing power expands faster than the baseline cost of living. Let us pause for a moment and look at the fascinating role that investor psychology plays when people try to make this transition for the first time. Human beings are hardwired by evolution to avoid loss at all costs, a phenomenon psychologists refer to as loss aversion, which shows that the emotional pain of losing a dollar is roughly twice as intense as the joy of gaining a dollar. When an investor sees their portfolio drop by $5,000 during a normal market correction, their brain processes that temporary paper loss as a direct threat to their survival, generating intense feelings of panic and regret. Conversely, when inflation quietly erases $5,000 of purchasing power from an idle cash account over several years, no single day displays a shocking drop, so the loss aversion trigger never fires. This psychological asymmetry creates a dangerous cognitive bias where people actively prefer a guaranteed, slow, invisible financial loss over a temporary, visible, and fluctuating market balance. To overcome this deeply ingrained survival mechanism, successful wealth builders reframe how they view volatility in the financial markets, shifting their perspective from fear to understanding. Market volatility is not a defect or a punishment, but rather the mandatory entry fee that investors pay to capture long-term inflation-beating returns over time. When you realize that short-term price fluctuations are simply the normal breathing pattern of a growing economy, the impulse to hide all your capital in stagnant cash accounts begins to fade away. Now, consider what happens when we zoom out and look at the broader macroeconomic picture that drives interest rates, money supply, and currency valuation over modern economic history. Central banks around the world utilize interest rate adjustments and monetary policy tools as levers to manage employment levels and maintain price stability across the national economy. During periods of economic slowing or systemic stress, policymakers historically lower interest rates and inject liquidity into the banking system to encourage borrowing, spending, and economic expansion. While these interventions are designed to stabilize the broader system, they simultaneously reduce the yield earned on traditional cash savings, punishing passive savers while rewarding those who own real productive assets. This structural reality means that individuals who rely solely on traditional cash savings are playing a game where the rules are systematically stacked against them over long horizons. When central banks expand the money supply, the total volume of currency circulating in the financial system increases, which naturally dilutes the scarcity and relative value of every existing dollar in circulation. Owners of productive assets such as real estate, profitable businesses, and equity indexes see the nominal value of their assets rise alongside money supply expansion, effectively insulating their wealth from devaluation. Savers holding uninvested cash, however, experience the full force of that dilution, finding themselves working harder and saving more just to keep their standard of living completely static. What makes this issue even more pressing today is the subtle interaction between yield, inflation, and federal income taxes, which creates a compounding drag on real returns that few investors calculate accurately. When you earn interest on a traditional bank account, money market instrument, or short-term deposit, the tax authority views those interest payments as ordinary income rather than lower taxed long-term capital gains. If you earn 5% interest on a cash deposit but belong to a 24% federal tax bracket plus state taxes, your actual net return after taxes drops significantly before inflation even enters the equation. Once you subtract a 3 or 4% real-world inflation rate from that remaining post-tax yield, your real rate of return dips directly into negative territory, meaning you paid taxes for the privilege of losing purchasing power. To visualize this friction clearly, imagine driving a high-performance sports car down a straight highway, but leaving the emergency brake partially engaged the entire time you're pressing the gas pedal. You are burning fuel, putting stress on the engine, and making plenty of noise, but the car struggles to reach its full potential speed because an invisible force is constantly resisting your forward motion. In personal finance, holding excess cash in inefficient, fully taxable accounts while attempting to build long-term wealth is the exact equivalent of driving with the emergency brake on. You're doing the heavy lifting by earning income and saving aggressively, but tax drag and purchasing power erosion are constantly pulling your progress back towards zero. This small detail changes everything about how you should structure your financial life moving forward, forcing you to look at every single dollar as an employee with a specific, assigned job description. In a well-managed business, an executive would never hire dozens of employees, pay them full salaries, and allow them to sit in the break room all day doing absolutely nothing to help the enterprise grow. Yet millions of hardworking people do this exact thing with their hard-earned dollars, allowing massive teams of financial units to sit completely idle in basic bank accounts, doing no productive work for their future. Every dollar you own should be actively assigned to a clear mission, whether that mission is immediate liquidity, emergency protection, short-term capital preservation, or long-term growth. Let us walk through a practical step-by-step framework that reveals how to fix this money mistake without taking unnecessary risks or exposing yourself to sleepless nights. The first step in this process involves conducting a complete financial audit of every bank account, checking balance, and cash asset currently attached to your name. Pull up your balance sheets, open your banking applications, and write down the exact dollar amount sitting in each account alongside the specific interest rate that account currently pays you every month. Many individuals who complete this simple exercise are genuinely shocked to discover that thousands of dollars have been sitting in old, forgotten accounts, earning a negligible 0.01% for years on end. Once you have a crystal clear picture of your total liquid cash position, the second step is to calculate your true baseline monthly survival expense, excluding discretionary spending, luxury items, and entertainment. Multiply that baseline monthly expense by 3 to 6, depending on your job security, family situation, and personal risk tolerance, to establish the exact boundaries of your emergency shield. If your baseline living costs are $4,000 a month, a fully funded 6-month emergency fund equals exactly $24,000, providing a robust financial buffer against real world unexpected events. Any liquid cash you currently hold above the calculated $24,000 threshold is officially classified as excess capital that needs to be put to work immediately. The third step in this optimization model is to upgrade the storage container holding your emergency shield so that your safety net works for you instead of bleeding value. By transferring that $24,000 emergency reserve from a traditional legacy account into a modern, high-yield, FDIC-insured vehicle or a Treasury-backed liquidity instrument, you instantly capture market-competitive rates without adding market risk. This simple administrative move, which often takes less than 15 minutes to complete online, can instantly generate hundreds or even thousands of dollars in annual interest on money you were already holding anyway. More importantly, it ensures that your emergency fund defends its own purchasing power against baseline price increases while remaining fully liquid for genuine emergencies. The fourth step addresses the excess capital sitting above your emergency shield, directing those funds into productive, long-term asset classes aligned with your personal timeline and goals. For goals that are more than 5 to 10 years away, such as retirement or long-term wealth building, historical economic data clearly demonstrates that broad market equity index funds and productive real assets provide superior protection against currency devaluation. By systematically automating monthly transfers from your checking account directly into low-cost diversified investment vehicles, you completely remove human emotion and analysis paralysis from the equation. Automation forces you to buy assets consistently regardless of market headlines, ensuring that you build real wealth through every phase of the economic cycle. Consider the profound psychological transformation that occurs once you transition from a passive saver holding idle cash to an active owner of productive wealth assets. When you are purely a passive saver, news headlines about inflation, rising prices, interest rate shifts, and economic turbulence generate constant stress because you know your cash is trapped on the losing side of the ledger. But when you become an owner of high-quality businesses, productive real estate, or yield-generating instruments, economic shifts transform from terrifying threats into natural market dynamics that work in your long-term favor. You begin to understand that as prices rise across the economy, the revenues, earnings, and asset values of high-quality companies naturally adjust upward over time, preserving your real net worth. What happened next in our understanding of behavioral finance reveals why so many people struggle to maintain the system over a multi-decade timeline. Studies consistently show that the biggest threat to long-term wealth creation is not market volatility, economic recessions, or bad tax policy, but rather our own internal urge to tweak, trade, and alter our strategy based on short-term emotions. When the stock market enjoys a massive prolonged rally, investors feel an overwhelming temptation to abandon their emergency cash reserves entirely and chase speculative momentum at market tops. Conversely, when severe economic recessions hit and asset prices drop dramatically, those same individuals panic and liquidate their long-term investments, rushing back into the false comfort of static cash at the absolute bottom. This emotional whipsaw effect is precisely why establishing clear, rigid financial rules before crisis hits is the single most important factor in achieving permanent financial independence. Successful investors operate like disciplined flight pilots, following a pre-flight checklist, relying on structured systems rather than emotional reactions when market turbulence inevitable occurs. They recognize that short-term cash exists solely to buy peace of mind and protect their long-term assets from being sold during market pullbacks, while long-term investments exist strictly to compound purchasing power over decades. By maintaining a strict boundary between these two operational worlds, they eliminate emotional decision-making and stay on track regardless of short-term economic storms. As we look toward the future, the economic landscape will undoubtedly continue to evolve with shifting interest rate cycles, changing tax laws, and unpredictable market environments. But regardless of what central banks or global markets do next, the fundamental principles of real wealth preservation remain completely immutable across time. Money is fundamentally a store of human time, energy, and labor, captured in a liquid medium designed to transfer your hard work today into purchasing power for your future self. Allowing your stored energy to erode quietly in inefficient, low-yielding accounts out of habit or fear is a tragic waste of the time and sacrifice you put into earning every single dollar. The biggest takeaway from this entire journey is simple yet transformative. Safety is not defined by the static number displayed on a digital bank screen, but by the real-world purchasing power of your money when you need to use it. True financial security comes from understanding the mechanics of money, overcoming behavioral traps, optimizing your liquid cash, and ensuring that your hard-earned dollars are constantly working as hard for you as you work to earn them. When you eliminate the money mistake of holding excess idle cash in the wrong places, you take full control of your financial destiny, moving from passive survival to permanent financial freedom. If you made it all the way to the end of this video, you now possess the knowledge and perspective that places you far ahead of the vast majority of traditional bank customers. I would love to hear your thoughts in the comments below. How much cash do you currently keep in your emergency fund? And have you already made the switch to high-yield strategies? If you found this breakdown valuable, please hit the like button, subscribe to the channel, and turn on notifications so you never miss our deep dives into personal finance and wealth creation. Thank you so much for watching, and stay tuned for our next video where we reveal the hidden tax strategies that the top 1% use to compound wealth completely under the radar.